Certainly we had a lot of mixed messages in the report, was our interpretation. So we continue to see moderate job growth, but the dominant theme in the labor market data is the fall in the unemployment rate. It's been happening in a significant way over the past year, actually the past 2 years, and it just continues.
Dean, no one's breaking out champagne at the White House. I mean, it's an 8.1% move. Outstanding. Governor Romney was out on Twitter, I saw, with a quote, "It's going down for the wrong reasons," right?
Well, certainly this report shouldn't make anybody jump up and down and say good times are back again. That would not be our message. But we think that what the decline in the participation rate, the bulk of that is demographically based, more than 2/3 of it. And importantly, it's not going back up in a significant way. We think there's a bit of an urban legend out there that the participation rate is going to surge, that's going to cause the unemployment rate to stop falling. That's never happened in the past, and we do not think it will happen this time either.
Are we retiring because we want to or because we have to?
We think there's some of both. Certainly the demographics tell us that the baby boomers are many of them are in the range where they would be retiring even in a good economy. Now there's unquestionably, because the labor market is weak, some more are retiring than otherwise would have. But what we're seeing is the take-up of Social Security benefits is a large portion of what's happening here.
They're substituting Social Security benefits for wages they can't find?
Certainly some of them are. Again, others would be retiring under any circumstance.
A fascinating time, folks. Look to Economic Policy Institute. Lawrence Marshall out with a rich note on productivity. I just published that at Bloomberg Business Week. EconoChat. Dreaded first chart. Let's bring it up. We got a million charts today. It's a Maki chart day. Minimum wage growth. Okay, average hourly earnings. And you can see we've come down. We had a revision, and we had 1.8%. So there's the wage growth. It's a Chartapalooza, and here's the real wage growth after inflation. Let's be kind. Wages are flat, right?
And real wages are not rising significantly. That depends on which measure, but none of them are rising in a significant way. What I'd also highlight, though, is the fact that nominal wages are growing is a signal there's not as much slack in the labor market as some people believe. If that were true, we should be seeing wage cuts, we should be seeing wage deflation. It's not there.
Is there two Americas, coders in Silicon Valley and everybody else? That's a joke, but are there two Americas out there? You're focused on that better America, that wage-growing America, and for a large part of America, it's just not happening?
There's certainly a bifurcated labor market. There's no question about it. If we look at the unemployment rate for college graduates, it's 4% right now, and it's been falling. For those with less than a high school education, it's 12.5%. So we are creating job openings, but many of them are requiring skills that many of the unemployed don't have.
Okay, explain this. Bring it up. Here it is, round trip to 1981, labor participation. A lot of the participation was women entering the workforce. Why is it going down now, other than the retirees?
What's happening are a couple of things. The labor force participation rate among women has flattened out. And that's not just during this cycle, it's really over the last decade. And I think that was a phenomenon that was on the rise and it naturally is flattening out. The other major factor is the decline among the baby boomers, the retirements among the baby boomers. There are a couple other smaller factors, such as younger households working less, prime-age males working less, that are also, over the decades, driving that participation rate down.
Okay, we're going to digress here with Dr. Maki. We're going to come back on the job report. We got a great question of the week, and we had to hire people from analytics in Bloomberg to open the mail. There were so many questions. We have two. Would you consider, for Chairman Bernanke, so Chairman Maki, it's your time to respond. Would you consider supporting initiatives to spur housing demand by making principal payments on residential mortgages tax deductible? Interesting question from David. Should we do that? It's another Feldstein tax preference, isn't it?
Yeah, I think one of the problems that we got into in the housing market in the first place was all of the tax incentives for housing. I don't think the way out is by piling on more and more tax incentives to try to get people to buy houses that otherwise wouldn't.
What's the way out? Price?
I think the way out at this point is time. We simply need to work down the large stock of existing home inventories, and that's going to take time. There's no shortcut that's going to make it go away quickly. There's no shortcut to a booming recovery at this point.
Another smart question here. Great questions this week. What would you say to Chairman Bernanke? How do the inflationary pressures the Fed must quell in the future, how do they compare with Robert Samuelson's late 60s and 70s? It's different this time, isn't it?
Certainly the forces at work are different now. In the 70s, we had a much more rigid labor market. Things were quite different. We had the massive oil shocks. So we wouldn't put this into the same category as that. But we would say there are medium-term inflation risks if
Right.
policy does not take account of that. I think there's a couple trends involved here. One is there has been some shift to part-time work in general, especially as we move to more of a service economy than a manufacturing economy. The second factor we've touched on, which is the demographics. As more and more of the baby boomers retire, that employment to population ratio or the full-time jobs to population ratio is naturally going to be declining. That number will be much lower a decade from now than it is now.
Joe Brusuelas of Bloomberg Economics published 5 minutes ago, and he says most of the growth we saw in this report came from 4 low-wage groups. It's not, there's literally a job shortage in some areas, right?
It's a very diverse and bifurcated labor market right now, and I'd hesitate to label any major sector as completely low-wage jobs, because there certainly is a range of jobs within each of the sectors. What we are seeing, though, is the job gains are most significant in the areas where education is required, high skills are required. That's where we're seeing the strongest job gains, as well as at the retail sector, the food and drinking establishments, those sorts of places. I
remember, and I speak of this with my conversation with Chairman Greenspan this week, when he was surprised at the persistency of productivity 10 years ago, whatever it was. That report we got this week wasn't that good news in the sense it was a negative statistic. Link in the productivity of the nation with what we saw in today's report.
Well, what we've seen on the productivity front is as the recession ended and we started the recovery, firms were very hesitant to hire. So even when their output was going up, they weren't hiring. Now we're seeing the back end of that, which is that even though output's growing only moderately, they're being forced to hire whether or not they want to.
And of the wide range of notes today, from very gloomy at different houses to those relatively optimistic where I put you, why are you optimistic after today's report and the previous month's report? Where does your optimism come from?
I think one of the reasons to not put too much weight on the headline job figure this month is that everyone was expecting weaker numbers relative to the December to February period. We were bloated by weather. March, April were hurt by weather. We're going to get back to the trend in the May to June type of time period. We think that trend is somewhere in the 200,000 range. Everything we look at is consistent with that.
Well, there's the optimism. Note of the day, please, if we could. We've got so many elements today, so many great charts. This is Rob Carnell out of ING. I'd say a more cautious house at ING than Barclays Capital. Rest of survey week, investors will be watching labor market data even more intently for signs of the U.S. slipping back into recession. I would call that an outlier call. What's your GDP call after seeing the labor spirit in today's report?
We're looking for 2.5% growth this quarter. So it's not a booming recovery, not a robust recovery, but a moderate recovery. And it's important to note the GDP and employment numbers have been kind of shifting around each other. Q1 was strong unemployment, softer on GDP. We think Q2 will be a little bit the other way. But everything we look at says we're still in a moderate recovery right now.
Now let's go to the great work your team does. And this, folks, we showed the other day. Thanks for the emails on it. Men to women participation. It's America's Man Session. You can see the stability through the decade, and then off we go with men challenged, stabilizing. Now, when you parse the data, college education, high school education, male, female, teenage, fossils, what's the thing that catches your attention?
Well, I think one of the things is what that chart highlighted. I think the main driving force there was the recession hit the construction sector and the manufacturing sector particularly hard, and those do tend to be more male-dominated than some of the other sectors. Now we've seen stabilization in both of those sectors, and that's why that chart has stabilized.
Median income, let's bring it up. Chart number 7, Elaine, if you could. This is a chart, I was not prepared for this. Real median income, stunning, simply stunning. You can see the slowdowns after 81, 82, the slowdown 90, 91. This isn't a slowdown. There is I ran a moving average across that, and we're pushing 10 years of inflation adjusted this away from the education, aren't we?
It's what we're seeing is a rise in inequality in the labor market. There's really no question about that. Part of this is the globalization, which is putting a heavy premium on education and skills. For those who are globally competitive, the wages are going up. For those who are not, the wages aren't.
How do you respond to people like DeLong across the pond from your Stanford or Krugman at Princeton who say, okay, here's the jobs report, here's the labor force decline, we need stimulus, we need to goose this economy, maybe reflate it a little, but certainly get nominal GDP up. How do you respond from the land of Boskin and John Taylor?
I think what I would highlight is the Fed's right at its inflation objective right now. 2.1% headline, 2% on core PCE price index. For the Fed to launch a major new stimulus program right now would very likely push that significantly higher. What the Fed chairman has said is the Fed doesn't want to risk a substantial rise in inflation for some near-term job gains. And to me, that's a reasonable case to make.